More than 1 million homeowners are facing up to increased mortgage bills this week after a number of lenders increased their standard variable rates. These increases could leave the average mortgage borrower paying an extra £200 a year for their mortgage. The standard variable rate is the rate you revert to when you come to the end of your fixed or tracker period. So if you sign up for a 2-year fixed rate, at the end of 24 months, you'll move onto the standard variable rate. And that transition can lead to payment shocks. Each lender has a different standard variable rate. Halifax is increasing its rate from 3.5% to 3.99%. The Cooperative Bank is increasing its rate by 0.5% from 4.24% to 4.74%, while Clydesdale and Yorkshire banks are moving their rates up from 4.59% to 4.95%. The Bank of Ireland is also increasing its SVR, though this will happen in stages, by 1% in June and then a further 0.5% in September.
We estimate that the impact of these rate rises is going to be an additional £300 million of mortgage interest for those borrowers who are affected. And for some individuals that could be hundreds of pounds added to their mortgage payments every year. And we really think that the lender's not playing fair with their customers here, because obviously if you're in a position where you've got lots of equity in your home, then of course you can move, you can take your business elsewhere. But for many people at the moment, after the house price falls over the last few years and the seizing up of the mortgage market, it's incredibly difficult to take your business elsewhere, and some people just simply can't do that. So there are going to be hundreds of thousands of people here who just have to take these rate rises on the chin and are effectively mortgage prisoners. And so the banks simply aren't playing fair with those customers.
The trouble with standard variable rates is that they're not formally linked to the bank base rate. That means that the bank sets the SVR and decides exactly when to raise it. So even though bank base rate hasn't moved in 3 years, that doesn't mean your rate is safe if you're on the SVR. So why are SVRs moving now?
Well, what we've basically seen over the course of the last few years is some challenges in the funding market. So for banks to raise funding, it has become much more expensive. Some of that is linked to the general state of the economy, but largely it's linked to nervousness around the Eurozone. Banks are also being asked to, if you like, store more capital for bad times relative or compared to how they used to do things 3 or 4 years ago, and that's new regulation basically. So fundamentally more costs are being forced onto the bank that the banks need to pass on to the customer.
What should the affected borrowers do now?
If you are affected by this and you're struggling to pay your mortgage, and we know that many people are, and are going to be hit by these rate rises, you need to go and talk to your bank as soon as possible. And the banks are actually under an obligation to try and help you out and to try and cut you a bit of slack in the first instance. They've made commitments to the government that they're going to do that, and although we've had indications that they aren't all doing that, they really should be, so you should be persistent with them there. But talk to them at the earliest opportunity, don't put your head in the sand, because hopefully they will cut you that extra bit of slack and let you get back on track with your mortgage payments so that you can afford to stay on top of them.
Whether this is the start of a trend or not remains to be seen. But what's clear is that mortgage borrowers enjoying the current record low rates on their mortgages need to start considering their options. Just because the Bank of England is sitting on their hands regarding rate rises, it doesn't mean that your bank is too.